Hi everyone, and welcome to this episode of Market Intelligence TV. My name is Matt, a ex-recruiter and a researcher, now interested more in the markets than anything, picking out patterns, talking about data, focusing on the research part of the statistics that are being released by the government and providing some insight in terms of how everything functions from the macroeconomic perspective. And I've got someone as a special guest, Imre. Imre, could you just very quickly introduce yourself to everyone?
Yeah, thanks, Matt. Happy to be here. So, as Matt said, my name is Imre. Currently I'm a fund manager trading a combination of investor and proprietary funds alongside legendary Wall Street trader Andy Krieger. Our focus is primarily on global macro discretionary structural plays, so very relevant to the kind of stuff that we'll be talking about here. And yeah, excited to get into all of it.
Yeah, awesome. This episode is going to be a little bit quickly. This is why we are pre-recorded there, just so we can get it out to everyone as soon as we can, because there's a lot to talk about from a charting perspective, not too much from the data perspective. So let's get straight into it. So in terms of, I was going to look at stock earnings, but we literally don't have time, unfortunately. But yeah, let me get through the data very, very quickly in terms of what happened, because there hasn't been too much data out there, unfortunately. In terms of what we had on Monday, manufacturing PMI for China was a little bit weaker than expected, still within expansion range. Nothing really to add. We've talked about it, a couple of weeks ago in terms of what's happening in China. So not too much to talk about there. The only interesting part I'll probably say for Monday's data was the Swiss inflation data is probably around that deflation stagnation point of view in terms of falling, which is pretty good overall for the Swiss franc. Obviously, it's keeping its strength for now, and I believe over the next 6 to 12 months, it will carry on keeping its strength. I mean, given this data that you've seen in terms of CPI for Swiss franc, anything that shocks you, or no change since the couple of weeks we spoke about it?
No, not really. Is my screen share visible, by the way?
Yeah, in terms of right now, do you want me to very quickly jump onto your screen? I can do.
Yeah. Just thought I'd share what I
Yep, go
see with
ahead.
the Swiss franc
Yeah, space
history.
is
All
yours.
right, so here we're looking at 6S, which are the Swiss franc futures. We're on a weekly time frame. Not gonna dig into the nitty gritty here, but we can see that going back to April of this year, we have established a very solid trading range, and there's been demand for the Swissy within this trading range. So currently trading at 124.745. There is clearly demand picking up here. The question is, will this demand hold? Which, as Matt pointed out, I would also expect it to hold, and I do think we'll see new highs in the Swissy. This is literally uncharted territory for the currency in many respects. Yes, we have, and you can see me going back here to 2011, a spike, but in modern, let's say more modern, more recent times, this is very interesting. Ask yourself, why would the market be so interested in buying Swiss francs? And I can't think of a very, very positive, optimistic answer to that question. The Swiss franc is traditionally seen as a safe haven currency. And so is the US dollar in many respects. Traditionally, there has been a link between the Swiss franc and gold. I believe that correlation has been in and out, over the years, but that could be something worth keeping an eye on right now is the relationship between the Swissy and gold as well, for those of you who are interested in trading gold. So if you're looking for a currency play here, I do believe that the Swiss franc offers very interesting reward to risk opportunities right now.
Yeah, and I think we're going to see further devaluation from the dollar. Seeing what's happening with recent state elections. That don't tend to like to go into politics, but sometimes politics do impact the market sentiment occasionally. We're going to have to see with this particular one, given the fact that we've still got an ongoing government shutdown, right? So the moment government opens, I think we're going to see some relatively steep movements, especially in the currencies. and given the fact that the debt is rising at, I believe it's $23 billion per day now, which is the new record. It's crazy to even think about it. The moment I was thinking $22 billion each day, on onto the US debt is crazy. But that's why Swiss franc is keeping its strength amongst other things. But yeah, definitely, definitely, definitely. Let me switch back to the data charts very quickly again. On Monday, apart from that, nothing really was of interest. Apart from the US data later on, ISM manufacturing PMI came out in contraction, shock horror. Manufacturing in the US has been in decline for 16 months, 17 months in a row, something crazy. Yeah, I literally stopped paying attention to that. However, the good thing is the prices paid are still accelerating, but the acceleration has slowed down, and has slowed down pretty dramatically, which obviously, yes, the prices are still going up from manufacturer's point of view, which depends how you look at it, can impact inflation. Inflation obviously has multiple driving factors from supply and demand, the prices of raw materials, so on and so forth. So yes, this could be an indication that inflation is still going to persist. By how much? Yeah, it's something that we're going to have to see really in upcoming CPI data, and that's going to be released. Any thoughts on the numbers from ISM?
Yeah, nothing too crazy in terms of adding on to what you said already. I don't think they've revealed a change in trend from anything that we've already seen as established.
No. And do you know what? I think people are paying less and less attention to the ISM numbers. I think numbers in general, I used to, and correct me if I'm wrong, Imre, but of in the last 10 years, especially in the early 2010s, data was, especially NFP data was considered to be this, breaking, market breaking news event. But recently, I'll be honest, I haven't seen any movements. Yeah, you see maybe 50 point, 60 point moves on the NQ, maybe 20, 30 points on S&P, but I haven't seen anything like, wow, this is market breaking or market moving. Have you seen that at all from that change?
Yeah, so data prints and market movements are really interesting. They tend to go through cycles
Mm,
where and it makes complete sense. Employment is not a concern. It hasn't been a concern for the economy since really COVID. I think
yeah,
that's about to change, by the way. But
yeah.
um, so in during COVID, NFP was a major factor.
Agreed.
The market was responding to employment reports because that was something that was of the utmost importance in focus for the market. So the market, and this is a bit of an oversimplification, but the market is generally looking at these data reports in terms of thinking how they're going to influence monetary policy,
Mm,
right? So if unemployment is soaring, that could lead the Fed, or most likely will lead to the Fed, to lower rates and ease the system with further money printing.
yeah,
That, in that context, a high NFP report could actually see, like a high unemployment, a bad print on the NFP could actually see the market rally. And this is where traders get confused. They say, well, why would the market go up on bad news? Well, the answer is now the Fed has more leeway to cut rates
yeah,
and ease monetary conditions further, right?
yeah,
So a lot of people will say, oh, buy the rumor, sell the news. No, it's not quite that simple. You have to think a couple layers a little bit deeper here to understand how the game is being played.
yeah,
And this is kind of the perverse divergence that you can see between Wall Street and Main Street at
yeah,
times. So that's just an example, but when in 2022, it was the news prints that would really move the market would be anything that had to do with inflation.
yeah,
Right. So it just depends on where we are in the economic cycle, the trading cycle, the monetary cycle, and that's going to determine as a result, what news events the market will be paying the most attention to.
yeah. Agreed. And I always think about from NFP or any major data, especially released nowadays with so many different algos, and Wall Street, they already have price is set up. So by the time it's almost, especially for retailers, it's basically a guessing game. How will market react? You might as well go to a casino and play a game of blackjack, essentially, right? Yeah, you might have an edge, but statistically speaking, you're going to lose more times than you're going to win, right? And especially in NFP data or any red folder data, yeah, 2-3 minutes before data release, algos are already prepared, ready to punch the price up and down. And unfortunately, for manual traders, it's impossible to react unless you're trading options, which Imre is a massive fan of.
Yeah,
So
unless you're trading options. The other thing to keep in mind too is that the liquidity, the order book is going to be extremely thin. It's going to be barren in the seconds before that data release. So it's not going to take a lot of volume to push a thin market around. Right? So just keep that in mind. The edge for manual discretionary traders, aka 99.9% of retail traders, in trading these news events is not to try to trade the initial burst of volatility. That I don't think that's where your edge lies. I think your edge lies in waiting for the liquidity to return to the book. And then you're going to see trapped inventory. You're going to see either trapped buyers or trapped sellers. So when people remark on how news events tend to reverse the entire initial surge, well, why is that? Is it because people change their opinions of the news so quickly? No, it's more of a mechanical uh, reason for that. And by mechanical, I mean the actual plumbing of the market and the liquidity moving through those sewer pipes. Right. So just keep that in mind. It is possible to derive some edge from event-based trading, even as a manual discretionary trader, but your edge trading an event is not going to be the same as a high frequency, algorithmic trading fund.
yeah, no, makes sense completely. Um, so yeah, let's in terms of US data, nothing really has popped up. ADP employment has gone up ever so slightly. Again, no one really cares about the ADP data. Out of the ADP NFP. NFP usually wins. Apart from that, yeah, the economy is pretty stable. Our expansion rate, slight expansion, 54.8, 54.6. Nothing to brag about really. ISM services came out a little bit hotter than expected. It was going to be around that stagnation. Well, slight expansion. Anything over 50 is expansion, right? So, slight expansion, but actually, it's a nice expansion to see from a services point of view. Obviously, the bad thing is the services prices paid, which directly impacts inflation, is accelerating at a really, really fast rate. 70 is a huge number. So yeah, something definitely to consider from that point of view. In terms of Thursday, yeah, nothing really popped up from BOE. They're holding rates. They can't really lower rates because the inflation is nearly at 4%, and it's actually rising again. House inflation has got up today for the month of October by 0.8% month over month, which is crazy. So yeah, UK is going downhill fast. Yeah, let me very quickly jump through the data because, as I said, we only got Imre until, well, for the next 18 minutes or so. So let me very quickly go through the data, and then Imre, if you've got any inputs, let me know. But yeah, on Friday, Chinese data pretty stable, nothing really to worry about. Yeah, exports have lowered due to tariff wars and whatnot, as expected. So yeah, we're going to probably see a little bit of a slowdown and then a big pickup during Christmas period for sure. And these are the numbers. What I mean, sorry, it was a 0.6 instead of 0.8 on the house prices that are going up, which is yeah, terrible news for the UK. Obviously, we don't have any NFP data. Sadly, it's not going to be released. We're going to have the Michigan consumer expectations. Nobody cares about that. I'll be honest. So yeah, Imre, from your point of view, I'll give you away to the charts. Go ahead.
Yeah, all right. So I think there's a few markets that obviously people are looking at very closely. We'll start things off with the S&P 500. So let's go to maybe not even the futures. We can look at the cash market. It seems to me like people are starting to freak out that the sky is going to fall. This is the longest government shutdown in history. It's going to be the most damaging as far as notional value goes to the economy. It's going to be a huge drag on GDP. Okay, let's keep something in perspective. Since the lows of April, going peak to trough to peak here, that is an insane percentage rally and a points rally. We've gone up over 2,000 points. So from the lowest low to the highest high this year in the cash market, we've done 43%. And along the way, if we look at the biggest pullbacks that we've had, well, we had one that was, what is that, roughly three odd percent. If I'm just looking at the closing prices, 1.5%, 2.3%, 2.4%. This is on a weekly chart. 1.75% so far this week. I'm sorry, relative to the rally we've had, we ain't seen nothing as far as a meaningful correction goes. If you look at April 2024 and the debt decline we had there, nearly 6%. July 2024, roughly from peak to trough, 9%. So what does it tell you about the psychology of a market that's freaking out? Don't hold me to that, but even if it's 3% down this week, is that really cause for alarm? Just being completely rational, not taking into consideration anything about the broader economy or anything like that. Is that rational? Now, the reason I'm asking that question is because markets are not rational. They're extremely emotional entities. So it tells you something about the state of mind of how bulled up this market is when it freaks out at the slightest downturn. That's very, very interesting to me. That's very interesting to me. Okay, now let's take a look at the futures for a moment because I want to go over what I'm looking at today. Today, we have some pretty interesting levels to keep in mind. I think below 67.09, things can get very interesting. We're currently trading at 67.22. On the other hand, if bulls can stay above 67.20 roughly, they have the chance to take control back at least for the session. One thing to note is that we're below the value area low of a rolling 5-day market profile. So we're starting to build value lower and lower and lower. Now, if you go back to this market profile view, you can see we had a 4-week balancing period, throughout pretty much most of October, even going back to middle September. And we're kind of in the middle of that balancing range right now. So the key question to me is this where the market is going to find fair value? And if the market can find fair value here, then we will normalize and then we'll eventually start trying to probe for higher prices. But if we can't and we break below this balancing area, we could be looking at the 65, 64, potentially 6300s next. And even that would not be from the perspective of how far we've gone since the end of April. Not even that would be quote unquote alarming. Now, if I'm going to inject a little bit of my own personal flavor and bias into things, I'm not calling for the top to have been put in place quite yet, but I will say this. I think we're in an environment where I don't know what other good news you could reasonably expect to come out. Now, I don't think that's how markets work anyway, but the point I'm trying to make here is that most people think of the market in terms of catalysts. What are the good news catalysts that are going to come from this? The government reopens.
Yeah.
Okay. Is that really amazing, blinding good news? Right. We've already had the major trade thing with China that seems to be more or less put to bed. I'm sure it will inevitably rear its head again at some point. So
Oh,
where's the good
100.
news going to come from? Right. So that's kind of my question. And can earnings be like the expectations that people have of earnings are absolutely insane. Can that pace be sustained as well? Right. So I see a lot more downside risk than I do see the potential for a further melt up. Now, very similar story to what's going on with the Nasdaq. So let's move on over to gold now, just because time is a little bit tight. If we're looking at what I want to draw your attention to is this distribution here in gold. This is a very important distribution indeed. Below that, it starts opening the door for significantly lower prices. 38.90s, 37, yeah, 37.90s, and then potentially all the way down to the 36.80s. Now, again, given the context of the craziness we've seen in gold, would that be off-putting in the sense of what a normal market should do? In my opinion, again, no. But gold and silver, the metals, silver being quasi-precious, I suppose, tend to be extremely emotional. And I think there is still some considerable trapped inventory, up above. So we'll see. I think max pain right now would be gold continuing to drop, especially if the market starts to actually, if the broader equity market, U.S. equities, either starts to recover or decline, and gold declines too, that would be really interesting. That would be a very, very interesting trade to take a look at. That said, we have found fair value here. We have found fair value, and I'm very open-minded now as to whether or not we can get another pop higher in gold. If we are going to get a pop higher in gold, I would initially target roughly the 4,100 level, 4,120 or so, which would be this distribution
Yeah.
up here. But I'm very open-minded. I'm personally flat gold right now. I think the next trade that I'll be making on gold will be a volatility play. I'll be looking for volatility to expand in gold. And
Yeah.
this is the way that I like to trade. I don't like to make the bet that the market's going to hit price X before it reaches price Y. I don't like playing that game unless I have very strong conviction across a multitude of different vectors in order to make that kind of play. I'd much rather play the game of, is volatility contracting or expanding? Is the market feeling generally fearful or generally greedy? Those are the kinds of plays that I'd prefer to make because they don't rely on price necessarily. Price is a factor, obviously, but rate of change is where I like to play. I think
Yeah.
that's a far more interesting chess match, if you will.
Mm. Yeah, definitely, definitely. I mean, with gold, right? I think we are in this position where it increased its market cap by what was it, 8 trillion, $8 trillion in the last 12 to 18 months, which is which is absolutely insane, right? At one point, it overtook the second largest currency in the world, which is euro. And again, that's no small feat. And we weren't talking about increasing the market cap, 20, 30, 40 years, which would make sense. It was months. So it only makes sense for gold to slow down a little bit and, people for, to start profit taking because of the move that's happened in the metal and, diversify it a little bit, and that's why we're seeing, for example, silver prices, hold the mark more than expected, even though it's the more volatile metal out of the two. For example, oil is holding relatively well. Would you say, or not? Because I can see you've got it on futures now. So yeah, what's your view on oil for now?
So oil is really, really, really interesting. So one of the craziest trading periods of my life was when oil went negative, and I was actually working with a large energy producer at the time. So the
Yeah.
fund that I was trading with at the time was an energy fund, and energy products was the only thing we were trading. And let me tell you, oil going negative was not on my bingo card. Since then, I've sworn off energy. For I needed a break. But
Yeah.
this year, energy has been a really interesting trade. So the cycle of an auction is that we start off with balance, and then the balance is going to break. This is the imbalance stage. And now the market is in search of discovery of new fair prices. Let's say the market goes up a little bit, finds new fair prices here. Well,
Yeah.
now what's going to happen? We're going to get into another state of balance. And then what's going to happen is the market will say, nope, we don't think this is fair value anymore. We're now in a state of imbalance. And now we're in search of discovery of new fair prices, which might be back here. And then the cycle continues. That is effectively the cycle of all markets. Balance, imbalance, discovery, then balance again. So if you look at the market, if you look at through that lens, you can see we had balance, imbalance, and then there's many micro cycles in there, right? And then discovery of new fair prices, and then balance again. This was a very significant balancing range. And then what happened? Imbalance, discovery, balance right here, imbalance, very quick rejection. So where we are in the cycle right now, I would expect more balance than anything. I know that's not a particularly bold call, and I wish I could be here telling you we'll have $100 oil or $20 oil in the next 3 months. I don't think that's likely. I think what
No.
we're more likely to see is a state of balance,
Yeah.
right? So for that reason, oil is not really on my watch list because um, oil is one of the few markets, and for context, when I was trading with this energy fund, I was scalping oil futures like a madman. That was my job. It was basically to hedge our gamma exposure, right? I do not enjoy doing that, but I developed an affinity for it. So oil is one of the few markets which I actually prefer. I love trading oil on a spot basis. Now, I'm interested in oil if we crack this. That would be very, very interesting. If we
Mm.
crack it and start shifting value, crack it, balance, break again, that would be interesting. Then I'm interested in oil is back on my watch list. On the other hand, playing it for the upside, sure, it is interesting, but we have a lot of work to do to break through this potential region of supply, then this
Yeah.
potential region of supply, then this old high. So I'm interested more so in playing a break in oil, right? Which would also be interesting. That would obviously signal a steep drop off in demand. I
Yeah.
don't think a break in oil should be construed as something being bullish for the broader global macro economy. In this case, in fact, that would be rather concerning.
Yeah.
On the other hand, a skyrocketing rise in oil could be driven by it. At this point, I think the most likely catalyst would be something geopolitical,
Yeah.
right? Which
100%.
at this stage is hard to imagine things escalating in that direction. Although Russia is being extremely provocative right now, it's
Correct.
not in their interest to escalate things with NATO right now. So
No.
the status quo for Russia right now is fine. They want to be seen as projecting a degree of strength, and we can see clearly from the NATO side that there's no interest in provoking Russia further, right? That
No, it's a
no matter
lose-lose
how
game.
much exactly, no matter how much the Ukrainians want Tomahawk missiles, the NATO is not going to be, the US specifically is not going to be really providing them
No.
unless there is a significantly marked escalation. In
Correct.
which case, yeah, $100 oil, here we come, right? So,
Yeah.
and then finally, the market I wanted to look at is Bitcoin.
Yeah, that's been
Oh,
interesting, hasn't it?
Bitcoin bulls, what has happened to you? Where's everyone that said we would never see
Yeah.
100,000 Bitcoin? Okay,
Uh,
so is Bitcoin over? No. No. I mean, and again, like this just shows you how insane people are. And yes, we're looking at a line chart, but I remember when a 20% drop in crypto would have just been shrugged off. Like, okay, get over it. Bear market for stocks, that's like barely a pullback in crypto. And now people are losing their freaking minds. That tells you something. That tells you something. That is very valuable information. It tells you that people want, they don't even want to be seeing dips. That you'll hear people say, oh, buy the dip, buy the dip. No, people don't want dips. They just want higher highs, higher highs, higher highs, higher highs. Okay.
yeah.
Now here, look, I'm not a crypto guy. I have so many things that are almost all negative to say about crypto, so I'm going to hold my tongue here. But
I'm gonna say it's a
what I
Ponzi.
will
I'm
say,
gonna beat you to it.
so what I will say is that from a technical standpoint, this trend line is so obvious. It's so obvious. Okay, so start thinking to yourselves, if it's this obvious, only one of two things can happen, right? We both know what those are. Either it's so obvious that people pile in with fear, they start cashing out, and we're going to see that big drop. Yeah, I don't think that's likely just because of how obvious this is. And my inclination here, similar to both with stocks and crypto, and if I have to eat crow for this, I will, is that I don't think these bull markets are done yet. I think we're limping along, and I think we have one more very weak high to establish, but then I'll be extremely, 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 extremely cautious, let's say. And this is the most cautious. This is the most extremely cautious I've ever been with my money to date in over the course of my career. Right. And so I'm very open to the fact that I'm wrong on my thesis and that we could have topped in risk assets. I'm very open to that. But my
Yeah,
personal bias, is that I still think that the on the sliding scale of probabilities, we still have another high left in us. But if I'm wrong, I'm prepared for it. And if I'm right, I'm going to give up a little bit of upside, right? So for me, the personal choice is where am I more comfortable with risk? And I'm more comfortable giving up a bit of upside here versus having the downside protection. Okay, so with that this major obvious trend line out of the way, we do have to go to a candlestick chart to take a look at some things. I'm not going to be talking about obvious technical patterns like head and shoulders and triangles and stuff like that. What I want to draw your
mm,
attention to is more where the market has previously felt comfortable doing business. And we're right in that area right now. We're right in that area right now where the market has previously seen this going back to December of 2024. So the end of last year,
mm.
the end of last year as being fair value. If this doesn't hold, yeah, we're going to be in for a bit of a ride. Okay, so I think the next couple of days, critical for Bitcoin, absolutely critical, because the next obvious place where the market felt comfortable doing fair value is significantly lower.
Yeah, I think that's gonna be we're gonna be in a lot of trouble when that happens because obviously, as we all know, a lot of the people are very leveraged, right, through hyperliquid, through other obviously avenues, which means that hey, once that support starts breaking, yeah, all hell breaks loose because everyone will have to sell their other coins in order to cover their margins and whatnot, and yeah, long and behold, we from 100,000, we might see 70,000 very, very soon, right?
Yes, exactly. So that's the last thing that I'll leave you with for now. Oh, and sorry, one more thing with related to crypto. The crypto market is hyper leveraged. All right, and I think the whole saga with the worst notional value liquidation in crypto on record from just a couple of weeks ago has shown that to be the case. When you have a hyper leveraged market, even small movements can create cascades of defaults and liquidations. So just if you are playing in these waters, just don't be an idiot. Don't be an idiot. Don't buy dips on like insane leverage using perpetual contracts, right? I have I have a little bit of crypto just so I can say I have some skin in the game. So if it goes to $1 million, I don't feel like a complete idiot. But it's not something that I dollar cost average into. It's not
Yeah.
something that I regularly invest into. I'm very open about that, and it's for a very simple reason. I just don't believe in the underlying promise of cryptocurrency. It doesn't make sense to me. The concept and the idealistic view of it, sure, yes, but I'm sorry, human nature doesn't work that way,
I
right? If
second
if
that.
if the if the idealistic view of crypto was in fact a reality, guess what? We'd also have peace on Earth. The aliens
Yeah.
would come and visit us and share their tech. We'd all be holding hands and singing "Kumbaya." So it's just not. I'm sorry. I'm happy to be proven wrong. I'd love to be proven wrong, but that's why fundamentally I'm a massive crypto skeptic. And again, I'm so open to the fact I could be wrong. I just haven't heard a convincing enough argument contrary to my views yet.
Yeah, I definitely second that. I think that potentially we might see an iteration of cryptocurrencies being introduced, maybe in our generation. Maybe we'll be long dead by then. Everyone's saying that we might go digital. I think we're going to go the opposite way when it comes to handling money for multiple reasons, right? Whether it's cyber warfare, etc., super intelligence, yeah, play a bingo list at that point, right? But yeah,
Yep.
for me, will Bitcoin survive another 20 years? No, I think it's going to go down to zero like most of the cryptocurrencies. However, will there be a substitute that's better than Bitcoin? Yes, in my opinion. But yeah, who am I to say?
Yeah. Well, like let's leave it there, Matt. I've got to run. But thanks for having me on. Thanks for everyone watching this. Sorry we couldn't do it live, but I think this was a pretty cool episode after all.
Yeah, no, listen, Imre, thank you so much for your time. Enjoy your Friday. Have a good Friday, everyone. And yeah, looking forward to next week.
All right. Cheers. Take care, everybody.
Bye.